Good morning, Armor Insiders. Welcome to the morning meeting, starting our new week. It's Monday. We come into today flat, looking to make our day trades, looking to carry on our armor carry trades. What I'm going to do right now is walk you through big picture macro, risk monitor, things like that, drill down into what groups are interesting, stocks that I may be long or short. We'll go over some of the ETFs I'm focused on. As always, you're the risk manager of your own portfolio. You're on this desk with me, which is a virtual hedge fund, right? So we're all around our virtual meeting table, if you will, getting ready for our trading session. So take the information I share with you and figure out how it applies to your strategy. So let's dive in real quick. This shouldn't be a very long and difficult conversation. It's pretty easy to see what's happening in the market. On the 15th of September, the risk monitor went red. The market has plummeted since then. We're protected. End of story. See you tomorrow. I mean, we could stop it right there. There's nothing new that's developed over the weekend other than corroboration of what we already know. Okay. So the risk monitor is comprised of 10 ETFs with algos designed for each one. And what we look for is confluence. When they're all moving in the same direction, if it's higher, that's bullish. When they're all moving in a lower direction, it's bearish. It's just that simple. Only institutions can drive action across all different markets. So if we can't get the confluence, it tells us something's wrong with the market. If every now and then we get a risk monitor green that immediately flips red, which happened this time, there is a very high probability somewhere above the 90th percentile that the market's going lower immediately. It doesn't tell us how much lower, but this is a perfect example of that type of selling, and I wanted to highlight it. Real quick, I'll just show you what I mean with the equally weighted index, okay? And this is important because we're trying to, kind of gauge what type of market we're in. The risk monitor went green here, okay? And then immediately flipped red here. So no real upside. Green up for a couple days, immediately down, and then flips red right there. And on that day when it flipped red, on the 15th, I said to you that there's a high probability, like in the 90 percentile, that the market's going to go lower using the ARMR algos. This exact setup happened 4 times in 2008. So I share that with you this morning so you understand the type of market we're in. The risk monitor is a gauge of market behavior across small caps, big caps, tech stocks, companies that are not tech related. Value stocks, momentum stocks, right? We're using all different indexes to get a gauge of the whole market. So it's a probability algo. It's important to understand. It's going to dovetail into my conversation about short selling in a minute. In 2008, there were 4 times where the risk monitor turned green. That was one of the worst bear markets in history. The risk monitor still turned green. Of course, it's going to turn green. There's going to be massive selling, and then the market takes a break, catches its breath, tries to rally. On each time that it tries to rally, we're going to put capital to work. Risk monitor is going to turn green. If it turns red immediately and we take some small losses there, that's when you flip short as the market goes down, makes new lows. That is the pattern of a bear market. So I'm going to get to short selling in a minute because I covered all my shorts going into the weekend, and I don't have any puts right now. And I come into this morning flat in my portfolios, with the exception of gold and oil investments. I'm talking about index positions, okay? So I'm going to share with you a whole bunch of negative things this morning. But I want you to recognize, even in the worst bear market in history, like 2008 financial crash, there were 4 separate times during the year where the market tried to rally off the low and did it to such an extent that the risk monitor went green. Okay. So I'm going to go over that in a minute. Now I'm going to share with you right now where we are in that process. Okay. So risk monitor red on the 15th, Armor Insiders protected. holding tons of cash, treasury bills, day trading, long or short, extracting extra alpha over the last couple of weeks when we can. That's our job right now. It's to be patient. It's to protect capital. And this is the most important thing to me. We absolutely must be ready for the turn in the market to the upside. That is our job. We can get in there and try to make some money short, but big picture at long-term investing, shorts lose every time. Big picture, long-term investing, shorts are going to lose every time. If we fall down the rabbit hole of short selling and we completely miss the turn in the market, we're going to underperform the indexes forever. You'll never catch up. So keep that in mind when I share with you some of these statistics that tell us the market's going lower. The risk monitor's red. Today, Investors Business Daily, I follow IBD. It's the core of all my processes from 30 some odd years ago. So I follow IBD. So they went yellow. If you remember last week, IBD was saying the market was attempting a rally. The risk monitor stayed red, but IBD went yellow, saying this could be a rally attempt. All right, that's off the table. Market back into a correction, for all the reasons that we know. You can take a look at this index here. Then you can just listen to the reasons that I posted for you in the captain's log this morning. All right, last week, and this is just some of the, according to the IBD, this is the way they describe it. Market suffered heavy losses. Treasury yields are exploding. It all goes down to this, okay? You just can't have a market going up. So now I'm going to tell you the negative picture, all right? I'm not telling you this picture to make you think we should be just short everywhere and looking for a market crash. That's the wrong headspace to be in. But I'm going to share with you why the fundamentals back up the risk monitor being red since the 15th of September. Right? There's no rainbow in sight. There's no different color that the risk monitor may be. It's just straight down right now. And so we're protecting ourselves. And it all goes back to rates. Okay. The 5 to 10 year now is totally imploding. We already knew that the 30 year was having a trouble, 20 to 30 year and longer. But now the 7 to 10 year paper is collapsing and we're above 5% and we're lower even this morning. Okay. So higher rates even this morning. Something has to break in the market is my expectation from a fundamental point of view. Doesn't mean I won't get long. The risk monitor goes green, but right now it's red and something has to break. The 10-year yield hit 502 last week. I think it's higher right now. The last time it traded there was 2007. Let that sink in. Last time the 10-year was at this level was 2007. Last week was the worst week for the auto industry since December 2022. And Joey's been putting some thoughts into the Slack room for us to back up that fact. Car owners now have fallen behind on their payments at the highest rate on record. According to Fitch Rating, Americans are falling behind on their car loans at the highest rate in nearly 3 decades. Rates are skyrocketing. It's killing people. This can't continue without something breaking. I'm going to show you the 3 charts in a minute that I'm willing to own puts on, be short. They're not indexes. They're group ETFs. I'm going to share with you that in a minute. But this list of things that I'm reading to you are like murderer's row. As of now, and assuming this holds to the end of the year, only 1998 was a worse year for the equally weighted S&P relative to the weighted S&P. We've been talking about that. There's 7 stocks holding up the market, and they let loose last week. Last week was a terrible week for the Magnificent Seven, and they have a lot of catching up to do to get to the equally weighted index, which is totally imploding. In fact, let's go look at the Russell, which is the worst. The Russell, geez, guys, the small cap index is just imploding. It's currently having its worst month relative to the S&P since last March, which is back in here. So this is just total annihilation. It's getting worse than then. And what's kind of concerning about all this, if you look back to equally weighted again, equally weighted has erased all of the gains going back to September of 2022. But what's really disturbing about all this, on top of it, it's all disturbing. Let's put it on top of that. When it comes to the Russell, for instance, Russell saw a reduction in the short position last week. Large speculators reduced their shorts last week, and the market hit new lows. Now, why that's important is shorts are natural buyers in the market. When they reduce their shorts, they're covering by buying the market. So shorts were out there buying the market yesterday, covering their shorts. You could consider me one of those large speculators because I did the same thing. And the market went to new lows on the week. So even short sellers covering can't stop the market from going down. This is all happening because rates are skyrocketing, and it just can't continue. Something's going to have to break. I don't know what it's going to be. Let's get to the indexes that I'm looking at for, where would I be willing to short? Okay. And I think it comes down to probably this. This is something that really disturbed me. I wanted to share with you this chart pattern. Okay. We have fresh lows now in the KBW bank index relative to the S&P, undercutting May lows. Take a look at KRE. That looks like the next level of the bear market has started in regional banks, undercutting the low of October and really beginning the next leg down. So it was a crash from up here, right? And we knew that from the issues with the bank run that happened in March, right? Then the market recovered. JP Morgan took over First Republic. Everything's okay in the world, right? And now we're breaking down again for the next leg down in banks. It's going to get ugly. So KRE has got to be a place where I'm willing to be short, or I'll own puts on the banks. You just can't have rates go through the roof like this and the economy start to implode, even though there's economic numbers tell us that's not happening. But we know in real life it's happening. We can see it. I'll be short regional banks again, either through puts or by directly shorting. You already know we've set up shorts on the home builders. I covered my puts at the end of the week, booked a profit. I'm looking to put it out at higher prices, or I'll put it out at lower prices. I don't care. I'm looking for what the next entry point is. We picked it off right in here. They broke down below the 200-day moving average, and I just wanted to take a break going into the weekend. I don't want to fall in love with the short side. I want to remind you, in the midst of all of this misery, our job is to get long on the turn. And this is very simple how we're going to do it. The market's going to turn. The risk monitor is going to go green. Actually, the first step is the S&P and the Nasdaq algos will probably go green first because they lead. So we'll get long the S&P and the Nasdaq 100 like we did a few weeks ago. And we'll capture the first pop off the bottom. It will then consolidate, go higher again, and the risk monitor will go green, and we'll add to our exposure. And what we're going to do is get 100% exposure to the indexes at that point. From that point, to capture the alpha we're creating by avoiding the market collapse. That's our key focus. It's not to be clever and be unbelievably short and try to make money as the market crashes. That is not our focus. The average investor, the individual investor, the guy who's not wildly speculative, the guy who's trying to put money to work, you and me, for the longer term, to build our net worth for our retirement and all those things. Our job is not to get lost down the rabbit hole of shorting. It's to be ready to put money to work each time the algos go positive. We know if it's like a horrible bear market, we'll put it to work and we'll get stopped out a couple times. We'll lose a little bit of money. Maybe we'll make some money. Last time we made some money. We picked off the market. It rallied for 5 days. We made money. We raised our stop. Okay. It's our job to do that each time. And when we get the follow through and the risk monitor goes green, that's when we have 100% exposure to the market right off the lows, capturing the alpha of being protective of the risk monitor red. Then the market will go like this. We'll have all the exposure we need in the portfolio from an index point of view, and then we'll start filling it out with our favorite investments. That will give us our alpha on the way back up. That's our goal. Don't forget it. So protecting capital now, taking some shots down the field short if you want, owning some puts on home builders or banks. I think real estate, here's SDS, SRS blew out last week. Maybe real estate again. Okay, I personally think, as you know, I keep talking about high yield debt. I just don't see how high yield debt doesn't implode at some point. So I've been trading the options, okay, and making money on the puts. Okay. But at the end of the day, our primary focus needs to be protecting capital right now. So even when I go out there short, even when I buy some puts, I'm not taking a lot of risk. It's just icing on the cake of the ARMR carry trade. I come in this morning, markets are down, right? Markets are down. My portfolios are all up. I'm green right now because I'm collecting interest in US Treasury bills. That's my job right now. And I'll take my shots at a couple investment shorts, banks, home builders, real estate, high yield debt. Those 4 areas I'm willing to be short or puts, but not to a degree that gets me off of my focus, which is to catch the turn in the indexes and then fill out the portfolio with ARMR power play names on the next upcycle, whenever that happens. It could be this week, next month, I don't know, next year, whenever it is. Our job is to be there. And the lower the market goes and the more defense, the more we collect our yield and wait, the wider the alpha gets, the more we're going to outperform for the rest of our lives. You know, market drops 25, 30, 40%, and we're in Treasury bills, and we pick up the turn, we win. We literally win. There's nothing else we have to do except for that singular focus. Don't get lost in the weeds. I'm telling you this. I'm giving you the benefit of my past experiences. I'm telling you right now, the money I made short in 2008, while it was great, and we made money in 2008, we were running hedge funds, we were successful in 2008. I didn't make nearly as much money as I should have coming out of 2009. Not nearly. We made money, but not nearly as much. And partially it's because when you get into a bear market and you start making a lot of money on the bear side, it is very hard to turn your brain the other way and say, it's over. And here comes the upcycle. And the upcycles are always bigger than the down. So get in there and take your shots when you want, but don't marry it. That's my message for you today, which is, I know it's a strange message because wildly negative, risk monitor red, avoiding all the collapse. We're doing the right things. We're going to make some money short. We're going to day trade long. I'm happy to day trade short. Made some good money the last couple of weeks day trading short. But I just want to remind you of what our real task is as investors. It's to take advantage of this weakness and put our capital to work correctly on the long side and then ride that into the sunset. That is the primary job. Okay. Hope you guys found that helpful. I look forward to working with all of you on the live desk at 9:30. Everybody, don't forget, you are the smart money. You can do it. Listen to all that you listen to, do all your work, create your strategy, and be the smart money. I'll see you guys on the live desk at 9:30.